Silver didn't just pull back from its highs, it shocked the market. After reaching historic levels that few traders believed were possible in such a short span of time, prices reversed with stunning speed. What made this move so unsettling was not just the size of the drop, but how quickly sentiment flipped. One moment, silver was being discussed as one of the strongest performing assets in global markets, and the next, it was being labeled one of the most volatile and dangerous trades on the board. To understand why silver prices crashed after historic highs, it's important to separate emotion from mechanics and look carefully at what actually changed beneath the surface. The rally that led to those historic highs was extraordinary by any standard. Silver didn't grind higher slowly, it surged. Prices moved through levels that had capped the market for years with very little resistance, and volatility expanded sharply. Daily price swings grew larger, trading volumes exploded, and participation widened across futures markets, ETFs, and retail platforms. This kind of behavior is usually a signal that momentum has taken over. When momentum dominates, prices can travel far beyond what fundamentals alone would justify, at least temporarily. At the peak of the rally, silver had become crowded. Traders who normally avoid commodities were suddenly involved. Retail participation increased sharply, and leveraged positions in the futures market grew rapidly. The narrative was powerful and simple. Inflation fears, strong industrial demand, supply constraints, and uncertainty around global monetary policy all pointed higher. As long as prices kept rising, that story felt validated every single day. But markets don't move on narratives alone forever. Eventually, positioning matters more than the story itself. The first crack appeared when buying pressure began to slow. Silver didn't collapse immediately. Instead, it started to hesitate near its highs. Rallies became shorter, pullbacks slightly deeper, and intraday volatility intensified. These are classic signs of momentum exhaustion. Early buyers, sitting on massive gains, no longer needed prices to go higher to feel comfortable. For them, the risk-reward balance shifted. Locking in profits suddenly made more sense than chasing additional upside. Profit-taking was the initial spark, but it wasn't the entire fire. Once prices started moving lower, the structure of the silver market amplified the decline. Silver is heavily traded through leveraged futures contracts, and leverage works both ways. During the rally, leverage magnified gains. During the reversal, it magnified losses. As prices dropped, margin requirements rose, and many traders were forced to reduce positions. These were not emotional decisions, they were mechanical. Risk systems triggered, stops were hit, and liquidation followed. At the same time, broader macro conditions began to lean against silver. The US dollar strengthened, making silver more expensive for global buyers. Bond yields moved higher, increasing the appeal of assets that generate income. Expectations around central bank policy shifted as economic data suggested that inflation might not fall as quickly as markets had hoped. Even small changes in these expectations can have an outsized impact on precious metals, and silver is particularly sensitive because it sits between the worlds of monetary metals and industrial commodities. Unlike gold, which is often held as a reserve asset by institutions and central banks, silver attracts a larger share of speculative capital. This makes it more responsive to changes in liquidity and risk appetite. When conditions are supportive, silver tends to outperform. When conditions tighten, it tends to underperform. The crash after the historic highs fits this pattern perfectly. As liquidity expectations shifted and volatility rose, silver absorbed the pressure faster and more violently than gold. Another key factor was the role of exchange-traded funds. During the rally, silver ETFs saw significant inflows as investors sought easy exposure to the move. When prices reversed, those same vehicles experienced rapid outflows. ETF selling feeds directly into market pressure, reinforcing downside momentum. This created a feedback loop where falling prices triggered redemptions, and redemptions added further selling pressure. Market psychology played a central role throughout this process. At the highs, optimism bordered on certainty. At the lows, fear replaced it just as quickly. Silver is notorious for these emotional extremes. When prices are rising, the market talks about shortages and new eras. When prices fall, the same market talks about bubbles and collapses. Neither extreme tells the full story. The crash was not a rejection of silver's long-term relevance, but a rejection of the pace and structure of the rally. As prices fell from their highs, attention shifted to key zones where the market might stabilize. One of the most important has been the area around $70 to $75. This zone matters because it represents where momentum first accelerated during the rally and where a large number of positions were established. When prices returned to this range, buyers and sellers both hesitated. Buyers questioned whether the market had fallen enough. Sellers questioned whether the easy downside was already behind them. Repeated tests of this zone increased tension. Each bounce was weaker than the last, and each drop felt heavier. This is how markets behave when they are trying to decide whether a correction is complete or whether a deeper reset is required. Institutional traders pay close attention during these moments. They are less concerned with catching exact tops or bottoms and more focused on whether volatility is expanding or contracting, whether volume confirms moves, and whether selling pressure is accelerating or fading. Large market participants tend to reduce exposure during periods of extreme uncertainty. That doesn't mean they have turned bearish on silver permanently. It means they are waiting for clearer signals. Stability, for institutions, is often more attractive than direction. They want to see whether support can hold, whether volatility calms, and whether macro conditions stop deteriorating before committing capital again. What happens next for silver depends on how these forces interact. One possible outcome is consolidation. Prices could remain choppy but contained, allowing excess leverage to unwind and sentiment to cool. This kind of sideways movement often feels frustrating, but it can be constructive. It gives the market time to rebuild a foundation without dramatic price moves. Another possibility is a deeper correction. If support levels fail decisively, silver could move lower as remaining speculative positions are flushed out. This would likely be accompanied by increased volatility and negative headlines. While uncomfortable, such moves are not unusual after historic rallies. They represent a reset rather than an ending. There is also the chance of a volatility-driven rebound. If selling pressure exhausts itself and macro conditions stabilize, silver could rebound sharply from depressed levels. These rebounds tend to be fast and emotional, but sustaining them requires broader confirmation from currencies, rates, and sentiment. Without that support, rebounds often fade. Going forward, several signals will matter more than daily price noise. The US dollar remains a key driver. Sustained strength in the dollar tends to pressure silver, while weakness provides relief. Interest rate expectations influence how attractive precious metals appear relative to other assets. Economic data shapes assumptions about industrial demand, inflation, and growth. Volatility itself is a signal, as contracting volatility often precedes stabilization. It's also important to watch how silver behaves relative to gold. If silver continues to underperform while gold remains stable, it suggests risk appetite is constrained. If silver begins to outperform again, it may signal improving confidence. These relationships don't offer certainty, but they provide context. Silver's crash after historic highs serves as a reminder of what kind of market it truly is. It is not a slow-moving store of value. It is a volatile, emotionally driven asset that rewards patience and punishes complacency. The forces that drove silver higher have not disappeared, but they have been overshadowed by positioning, leverage, and shifting macro conditions. Uncertainty remains the dominant theme. Silver may stabilize, it may fall further, or it may rebound sharply. What matters most is understanding why the crash happened and recognizing that such moves are not anomalies in silver. They are part of its nature. In a market where emotion and mechanics collide, respecting volatility is not optional, it is essential.